Okay, let's dive into this. Welcome everyone. Today we're tackling a concept that can literally make or break your trading account, and that's mastering market mechanics through the break and retest strategy. If you're looking for focused, no-nonsense learning on how the markets actually move behind the scenes, you are absolutely in the right place. We're going to break down exactly how you can stop getting trapped by the market and start trading alongside the smart money. Let me ask you something. Have you ever been staring at your charts, waiting for that perfect setup, and suddenly you see price aggressively surging toward a massive resistance level? I mean, the momentum looks completely unstoppable, so you jump in, you buy the breakout, feeling absolutely great about your entry. And then, bam, almost instantly the price stalls out, reverses violently, and plunges straight through your stop loss. It's an incredibly frustrating experience, right? You're left sitting there wondering if the market is just specifically out to get you. Well, if you've ever lost money chasing a breakout like that, I want you to know you are definitely not alone. In fact, the sources we're analyzing today reveal a statistic that is, honestly, pretty staggering. Between 50 to 70% of breakouts at obvious support and resistance levels actually fail. Just let that sink in for a second. More than half the time, that obvious breakout that looks so tempting on your screen is literally nothing more than a trap. So your frustration? It's completely validated by the data. The market is naturally geared to trap traders who act on impulse rather than structure. Let's move on and see how this builds. Here is our roadmap for uncovering these institutional secrets today. First, the false breakout trap. Second, signs of price manipulation. Third, spotting a true breakout. Fourth, the break and retest strategy. And finally, setting stop loss and take profit. All right, part 1, the false breakout trap. Let's get into the deception. So those failing breakouts we just talked about, yeah, they aren't just a streak of bad luck. They're often a deliberately built-in market mechanic. We define a false breakout or a fake out as a market deception where the price briefly crosses a key level on noticeably low volume. And the entire goal here is to trigger the stop-loss orders of retail traders, only to quickly reverse direction right after. It's essentially a contrarian move. The market is designed to flush out emotional traders who enter a trade just because it feels safe after a big, flashy green candle. Professional trader Niall Fuller hits the nail on the head in our sources. He says a false break of a level can be thought of as a deception by the market because it looks like price will break out, but then it quickly reverses. I absolutely love this quote because it highlights the psychological warfare happening right on the charts. It's deceiving everyone who took the bait. The professionals literally wait around for these amateur missteps so they can enter the market with a super tight stop loss and a huge risk to reward potential in the opposite direction. Moving right along to part 2. Signs of price manipulation. Let's look at the puppeteers. So if this is a trap, who exactly is setting it? Well, let's lift the curtain on institutional market makers. To really understand this, we have to look at the anatomy of an institutional stop hunt. Big institutions need massive liquidity to fill their huge orders, right? If they just bought everything all at once, they'd cause massive price disruptions. So what do? They target liquidity pools, areas like equal highs or equal lows where retail traders naturally cluster their stop-loss orders. They deliberately push the price past these key levels to trigger those retail stops. Once the retail panic orders flood the market, the institutions just absorb all that liquidity to build their own positions. After their orders are filled, they rapidly reverse the price back in the true direction. You aren't just getting stopped out, you're actively providing the liquidity they need. There's a brilliant real-life analogy from our source material that really drives this home. Think of a fake out like getting incredibly lucky on day 1 of a funded account evaluation. You hit a big win, you get super excited, but you didn't actually follow your rules. Well, very soon those gains disappear and you lose it all. A real breakout, on the other hand, is about building a consistent, disciplined edge. You wait for the right setup and you strictly follow your risk parameters. Remember, emotional discipline is what separates the temporary trap from the sustained trend. Okay, part 3, spotting a true breakout. How do we find the real deal? What's really interesting here is the contrast. How do we actually protect ourselves? We need a tactical filter. For a true breakout, volume is your absolute truth serum. You want to see volume that is 1.5 to 2 times a 2-0 period average. Plus, the candle body must close firmly outside the level. We want to see a large body with minimal wicks, which proves institutional momentum. Finally, it should follow some sort of structural buildup or compression. On the flip side, a fake-out trap is characterized by low trading volume, weak momentum, and long wicks that indicate sharp price rejection. Very often, these are sudden emotional spikes driven by news that just fade as fast as they appear. Which brings us to part 4, the break and retest strategy. This is your ultimate defense, and this brilliantly illustrates our game plan. Armed with that filter we just talked about, we can establish our strategy to protect against these traps and actually capitalize on real moves. Notice how the price is consolidating between support and resistance. Then we get the breakout. But here's the secret. Instead of rushing in to buy the breakout right away, we wait. We wait for the price to pull back and retest that broken resistance level, which is now acting as our brand new support. By waiting for this retest, you completely avoid those false breakouts and secure a much safer, confirmed entry point. Let's walk through the exact chronological steps of executing this. Step 1. You spot a valid breakout with that strong volume we talked about. Step 2. This is the hard part. You sit on your hands and wait patiently for the price to reverse and retest the broken level. Step 3. Look for a rejection candle at that retest zone. You want to see a pin bar with a long wick or a strong engulfing candle, proving the buyers or sellers are actively defending the new level. And step 4, enter your trade only after that rejection candle fully closes. Waiting for that close is your final confirmation that you aren't being lured into a trap. Finally, part 5, setting stop loss and take profit. Let's talk about managing your risk. Because look, getting into the trade is really only half the battle. If you don't manage your risk, especially when the market gets highly volatile, it's going to take your money eventually. Let's detail the exact mechanics of your order placement. Second, scale your position size to match that specific stop distance. And third, set your take profit at the next major structural level or simply use a fixed risk to reward ratio. So the absolutely crucial point here is this. In highly volatile markets, adhering strictly to professional risk metrics is the only true way to survive the inevitable losing trades. The professional standard is to risk a maximum of just 1 to 2% of your account equity per trade. Your risk to reward ratio should aim for a 1 to 2 or 1 to 3 minimum. That means you're making 2 to 3 times what you're risking. And finally, as the trend progresses in your favor, protect yourself by adjusting your position. Move that stop loss to break even to lock in a risk-free trade. As we wrap up today, we kind of need a quick reality check. Even with perfect volume, a beautiful retest, and all the confluence in the world, no strategy is 100% foolproof. The break and retest is a fantastic filter to keep you out of bad trades, but it is not a crystal ball that predicts the future. Sometimes perfectly good trades will just fail. And that is exactly why relentless risk management, emotional discipline, and proper position sizing are your only real safety nets in this game. So I want to end on a provocative note here and challenge you a bit. The next time you sit down at your charts and you see this massive, flashy breakout happening in real time, take a breath. Ask yourself, will your next trade be a calculated retest or an emotional trap? Apply the filter we talked about today, wait for that confirmation, and most importantly, protect your capital. Thanks so much for joining me on this explainer, and happy trading out there.